Hello, and welcome to this segment of IPPFA TV. My name is James McNamee, and I'm the president of the Illinois Public Pension Fund Association. And with us today, our special guest, is Bill Atwood, the executive director of the Illinois Firefighters Pension and Investment Fund. Bill, welcome and welcome to IPPFA TV.
Thanks, Jim. I'm glad to be here.
So one of the things we wanted to ask you, because this is such a big project that you had to tackle, which is bringing all the assets in from how many funds was it, Bill?
About 295 thereabouts when we started.
So it's 295 separate firefighter pension funds that you had to bring their assets over and set up this investment pool. And that was not only just setting up the pool, but you had to hire out the staff, you had to put together all the infrastructure. Was this quite a challenge for you?
Oh yeah, it was quite an undertaking in that there was no playbook. There was no set of instructions about how to do this. And to your point about having to set it up from scratch, my first action as executive director in March of 2020 was to open a checking account. So we literally started from having to open a checking account and go from there. And of course, that was also right at the very beginning of the COVID pandemic. So there was a lot going on in the world at the time.
You had a lot of challenges right out of the gate, which, like all of us dealing with that COVID pandemic, was especially difficult. But also the fact that you were putting together this fund, this large fund. What's the asset size right now?
Right now, I just checked before the call. As of yesterday morning, $10.9 billion.
So you got $10.9 billion. You have some, probably about 2,000 pension trustees that you report back to, all these different stakeholders. And so you've had quite a project on your hand getting this together, but you didn't come into this project unequipped. I mean, you had a background in dealing with things, and we could talk a little bit about that.
Yeah, when I was retained for this position, I was pretty confident in my ability to execute, just for the simple fact that I'd been doing this a long time. I cut my teeth in the 1980s working in state government. Then, basically in the 90s, I went to work for a money management firm in St. Louis and worked with a conventional boutique equity and fixed income shop. And then in 2003, I was retained to be the executive director of the Illinois State Board of Investment and served in that capacity for 15 years before doing a couple of years of pension policy work at the Illinois Finance Authority, and then was retained by this board, as I said, early in 2020. So between my experience in state government, my experience with money management firm, and then most importantly, 15 years managing a $20 billion public pension fund, I knew what IPPFA needed to do, but that still wasn't quite the same thing as setting it up. Nobody had really done this the way we are doing it, or we have done it, and so we just had to do the best we could. But the General Assembly and the statute kind of set up some broad criteria about how to set up our fund, just like they did for the police. And they also gave the board broad rulemaking authority. So between the parameters that the General Assembly established and then our ability to craft rules about the transition, we were able to execute the transition, as painlessly as possible. And before we did that, I made clear to various stakeholders, including the IPPFA, that we had no margin of error. I mean, there was no close enough when you're dealing with $7 billion of public pension assets. So not only did we have to get it right, though, we had to be able to prove that we got it right, which is to say that we were transparent and audited and auditable. So I'm happy to say that once it was all said and done, we followed all the audit protocols, and all the audits came through clean. Every dollar was accounted for. And so by the end of the transition period, these assets were transferred over in good order.
So you had some experience, like you said, with the Illinois State Board of Investment, and that's also a pooled, not as many, not over 200 some public pension funds. It was like, what, 4 public pension funds, but the asset size you said was about $30 billion. So it was
At that time, it was about 20.
Or $20 billion. Okay. And since taking this job on, did you guys have any other template you could look at? I know Arizona did this, Indiana. Lots of states have got a consolidation that they've done. Were those helpful or looking at some of that?
Well, in point of fact, I did have conversations with Arizona, with the Arizona Police and Fire Pension Board, and it was helpful. But you got to keep in mind, Arizona did their consolidation, I think, in the '80s. It was some time ago. And so, first off, their institutional memory of how they did the transition was a little foggy, and it was just a different world then. And so, the best help for me was really the structure of ISB. And like you said, ISB is an Illinois pooled fund. There are four investors in the fund, and so you have to allocate that. You have to allocate those assets on a pro rata basis to each one of those four investors, uh, and do so on a regular basis in a gap compliant manner. Um, so that was a nice start. But as we've talked about, ISB had four investors. Uh, the Firefighters Fund today has 302 investors. And not only do we have 302 investors, but at ISB, all four of those investors had the same fiscal year end, including us. All was a June 30th fiscal year end. With the fire funds, there are 8 different fiscal year ends for which we have to issue gap compliant reports, which just creates the audit and accounting responsibilities that we have that much more complex.
And obviously, the job running this thing is very complex. And right now, with all the assets that you have under management, what challenges are you facing in getting those assets into the marketplace? Are you guys going right now into certain areas? Obviously, the local funds couldn't go into before, which is like the private equity, the more areas of management where you have to have a certain amount of expertise and specialty, and also a certain asset size to get into.
Yeah, so we made we were very intentional about how we would make this approach, because the sort of two policy goals of the consolidation. One was to manage costs, and the other was to provide better returns. As you alluded to, the one of the critical elements of providing better returns is having access to asset classes that previously local funds couldn't have. But accessing things like private equity and private credit and real estate takes time, and also you have to have an infrastructure in place because these are difficult decisions to make, and you have to have plenty of expert support before you start deploying capital. So within that context, when we did the transition in 2001, 2002, we adopted an interim asset allocation, which was strictly uh, stock and bond index fund, so that as the money came in, we could get the money immediately invested. Then, once the transition was concluded in July of 2022, then we started transitioning into the long-term asset allocation. So we moved first into active fixed income, because we felt that's an area where active management could add value. But at the same time, we started building out the infrastructure so that by 2023, we were starting to deploy capital into private markets, so that today we have about 9% of the portfolio invested in private markets. And by the end of this month, by the end of October, that number will be closer to 11%. And our ultimate goal is to be at 28%, and we would expect to be there within the next 2 years. And the private markets portfolio is in four categories: private equity, private credit, real estate, and infrastructure. It's 10% private equity, 6% private credit, uh, 9% in real estate, and 5% infrastructure.
And with a lot of funds, because I've been doing this for a long time, that private equity portion or the private market portion has always been the leader and returns for a lot of the funds out there. So getting this exposure is really important and really good for the funds to be able to get that extra pop of investment into the marketplace. And I'm really thrilled to see that you guys are fully going into that, because I've seen the returns, I've seen the other funds and how well they've done with this, and it's got a long track record of doing quite well. We're even seeing our friends over in the United Kingdom now really looking at private equity. That's their big push over there now. They're starting to go into it because of the experience of the United States on that type of investment strategy. But all of this strategy, all this stuff that you've put together and everything, obviously one of the key components that was important for you was communication, correct?
Yes, sir.
And communicating, and there's a lot of people you got to communicate with, because you got all those different funds, all those different pension trustees. So you're putting out all those reports to them. You've had to build out a website to communicate with them and all that stuff. So this is really quite a job. I mean, it's people, when they look at it, they don't realize how big of a project this all was. And and it had to be like the cherry on top for you in your career, because when you look at this is a once in a lifetime opportunity, and and it had to be extremely exciting, for you. Just my own opinion.
Yeah, no, it was very exciting. It was and is very exciting. It's a rare opportunity to be able to stand up a brand new defined benefit pension plan. That just doesn't happen very much these days. And given where I was and in my career, that just it was just a great opportunity for me. A colleague said to me a few years ago that, well, this is going to look great on your resume. And my response to that was, I don't really care much about my resume. I'm more concerned about my obituary. And so this is, Lord willing, this is my last rodeo, and I hope to end my career here. And you're right, I'm very proud of the work we've done and what we've accomplished. Um,
So, going forward, obviously, you've got all these different funds. Every one of them has to be turning over assets every year to you. Obviously, some are under financial stress and don't have the ability to turn over. Has that been a problem also for you guys managing that?
Well, the issue for us is understanding what our cash flow situation is, and what funds cash flow needs are. And we've addressed that, I think, in a way that we're very comfortable with, in that most of the outgoing assets that go from IFPIF to local funds happen through recurring instructions, so that we know that every month we're transferring out approximately $52 million to local funds for them to meet their needs. Many funds don't take any money from us because their internal cash flows are sufficient to cover their needs. But we know, and we can plan for that $52 million a month outflow, and we can plan for it in terms of managing the cash in our portfolio and whatnot. And on a given month, we might have another 500,000 to 1.5 million of additional cash flow needs. But for the most part, we can really plan on that $52 million number. And then, as you know, through the course of the year, incoming cash flow is very lumpy. We get large inflows as property tax receipts are distributed. There's a steady flow having to do with payroll that comes in, or either stops at the local fund or maybe transferred to us. But since inception, we have been cash flow positive year after year. There's more money coming into IFPIF that is being transferred out to meet local fund expenses.
And that, my hat's off to you. That's really important. I mean, that really was the gist of putting this all together. Keep costs down, get good returns, and manage the assets well, which you guys have been doing. So again, we thank you for that, Bill. Anything else you'd like to tell our audience before we close today?
No, other than there's just two things. The staff, the board, everybody who touches IFPIF uh, is acutely aware of their duty and their fiduciary responsibility and their obligation to 20,000 firefighters in Illinois as their families, and as well as the communities that they serve. Uh, Everybody on the staff is incredibly proud to have this opportunity, not just the professional opportunity of creating this new organization, but of serving those firefighters and our first responders. Another thing I would like to share and to remind everybody that, when we started, Chuck Sullivan, the president of the AFFI, was the first chairman of the board. And at one point, Chuck came to me and he said, "Bill," he said, "can I take my IPPF hat off and put my AFFI hat on?" And I said, "Well, sure." And he said, "I need you to make me a promise." And I said, "What's the touches IPPF? They need to have a positive customer experience." And I thought to myself, well, and I said to him, I said, "Yeah, Chuck, you're absolutely right. Everybody who touches IPPF should expect a positive customer experience." And so between the board, myself, and the staff, we take that very seriously. We try to be as customer centric as we can be, and try to help everybody. It's all about meeting the needs of these local funds, and that's what we're here for. And so we do that, try to do that as professionally and as responsibly as we can.
Well, here at IPPFA, we'd like to thank you for all your communication with us. You've been great. We appreciate that, and we think that your organization is doing quite well, and the returns have been good. What we hear back from the members has been very positive. So again, I thank you, Bill, for taking your time out of your busy day today and appearing with us on IPPFA TV. And we're going to end this segment here.